Hello and welcome to Bondcast, a podcast series where we discuss our views on the latest themes and events shaping rates markets. I'm Imogen Bachra and I'm joined today by our global market specialists Stuart and Joann Spadigam. We're recording this on Thursday, so straight after a busy week of central bank meetings with the BOE and the Fed, which will be the focus of a lot of what we talk about today. But before we get into that, just a quick flag to our listeners who won't be able to tell for anybody that is listening and not watching, but this will be my last podcast for a couple of months as I head out on maternity leave next week. But I leave you in safe hands with Joann and Stuart and the rest of the strategy team, and we'll be back in the new year.
We're recording just after the Bank of England meeting, Imogen. A fairly interesting vote split here. How do you see things following the meeting today?
Yeah, so we just had the Bank of England meeting. They delivered a 25 basis point rate cut, as was widely expected. But the meeting as a whole had a very much more hawkish feel than I think we and certainly than markets were expecting. Joe, as you point out, part of that hawkish feel was to do with the vote split. We had expected that there would be two dissenting votes for a 50 bip rate cut, so that would give it a kind of dovish feel. But actually, whilst we did get two dissenting votes for a 50 basis point rate cut, we also got two dissenting votes for unchanged rates. And the key elements of the guidance remained unchanged as well. So there'd been lots of discussion in the lead up about whether the Bank of England would retain the kind of wording around the monetary policy reaction function being gradual and careful, whether they would retain language within the minutes around the need for policy to still be restrictive. And of course, it was a monetary policy report meeting, so we also got updated projections. And those projections weren't revised as much as we had been expecting, so only really very marginal shifts. So all of those elements together, I think, on the surface gave it quite a sort of hawkish cut feel. But there's a couple of other points that I would highlight that I think make this even more of a hawkish meeting than just those sort of surface level observations. The first is that whilst I talked about that sort of hawkish vote split, even with that majority five, so the five that voted for a quarter point cut, the minutes noted that prior to the tariff developments, there was a majority within that five who thought that this decision was quite finely balanced, i.e. whether to cut rates or not cut rates. So you take that with the two that voted for unchanged rates this time, and there's at least kind of five on the committee that, prior to any tariff developments, may not have voted to cut rates at this meeting, which is quite hawkish relative to market expectations, which were fully priced for a rate cut heading into this meeting. The second point I would raise, which is related to that, is that although that was a kind of prior view, i.e. it feels a little bit like old news already. They were stating what they would have done had there not have been tariff developments, which of course, as we know, over the last 4 weeks or so, there's been lots of new news on that front. But Bailey did reference the fact in the press conference that, of course, all of these judgments were made prior to a potential UK-US trade deal. Now, we're recording this just as we're expecting an announcement to be made. So we don't have the details yet of the trade deal as we're recording this, but it does appear likely that, imminently a UK-US trade deal will be announced. And that's important, not necessarily for the details of the trade deal or even how meaningful that may or may not be from a kind of growth or inflation perspective, but really from the perspective that, the uncertainty around global tariffs was a big driver of what pushed those members that thought that this decision was finely balanced into voting for a rate cut this time around. And so to the extent that had they known about a trade deal prior to making that decision, perhaps that means that we could have got an even more hawkish outcome this time around. And of course, there's there's other elements of uncertainty in the UK economy right now that go beyond just what the UK and the US trading arrangement is. But nonetheless, at the margin, I think we have a kind of renewed sense of hawkishness from that vote split and the rhetoric around it, given what we now know on the direction of travel of the UK and US trade deal. The other point I would make is with regard to the scenario analysis. So partly as a result of the Bernanke review a couple of months ago, the Bank of England at the back end of 2025 introduced to their guidance a set of scenarios. So they previously had three cases: a sort of central case, case 2, a more dovish case, case 1, and a more hawkish case, case 3. Prior to April the 2nd, in the February meeting and in the March meeting, we got a sense that the majority of the committee was starting to lean more hawkishly. They were placing more weight on case 2 and case 3 than they were on that dovish case 1. But in the March meeting, it kind of teed up a revision to those cases. Of course, at the time, we thought that was going to be in a more hawkish direction. But given what we've learned over the last couple of months in terms of the economic outlook and how tariffs influence that, we had sort of penciled in that at this meeting we might get a bit of a dovish revision to the scenarios, or at least a bit more emphasis on that more dovish scenario when it came to inflation. What we actually got in the end was a little bit of an overhaul to the scenarios, in the sense that the Bank of England presented just two cases now, two scenarios, rather than the three, although perhaps you can interpret that their sort of, base case scenario was the sort of central scenario and what we might call case 2 now, but that wasn't how they referred to it. And although they didn't give much away in terms of how individual members were placing the weights on either of those two scenarios, I would say that at the margin, the scenarios had a hawkish skew to them, in the sense that in the dovish scenario, the downside risk to inflation scenario, the collective judgment of the MPC was that it would remove about 30 basis points of inflation across the forecast horizon relative to their central case. Whereas in the hawkish scenario, the one that saw bigger upside risks to inflation, they saw that adding about 40 basis points, 0.4 of a percentage point, to their inflation forecast across the forecast horizon. So there was a bit more of an upside risk to inflation, in other words, in scenario 2 than they saw in equivalent downside risk in scenario 1. It was also interesting, I think, that even though Ramsden, who typically over the last couple of months has been leaning a little bit more dovishly, when sort of pressed in the press conference around who places more weight on which scenario, he talked about the fact that although he voted with the majority, he is still concerned about potential upside risks to inflation not coming off so quickly if productivity doesn't rise as the Bank of England is expecting. So even the more dovish members of the committee or of the MPC are still worried about those upside risks, and they didn't emphasize the downside scenario as much as we had been expecting. What does this mean for markets? Well, I think it makes a June cut, still very unlikely. Market pricing had gotten ahead of itself, I think, in expecting, potentially back-to-back cuts, or even the BOE to signal that outsized kind of 50 basis point cuts were on the table at this meeting. And that wasn't the case at all. So I think the market is right to rein in expectations for a June cut. Market pricing out to November looks relatively close to our base case. We have 2 more rate cuts in our projections in August and in November, so in the next 2 MPR months. And market pricing is broadly aligned to that. Beyond that, market pricing is a little bit more dovish than our central scenario. It has terminal probably settling around 3.5%, which is sort of 1 cut more than we have. I recognize that risks are sort of skewed in that direction, and those risks might materialize more clearly at the end of this year, early next year. But I wouldn't push back significantly on current market pricing. I guess the only point to note, or the only part that I perhaps would push back on a bit more meaningfully in the near term is that whilst June pricing has receded significantly, it's gone from about 50-60% of a rate cut being priced earlier this week to now about 25-30% at the time of recording. That still feels a little bit elevated. I think after today, we have increased confidence that actually a June cut, back-to-back cuts departing from this gradual guidance feels very premature. I would put the likelihood of a June cut at this point at about 10%. But that's probably enough on the BOE because, of course, it wasn't just the BOE that met this week, it was the Fed. So, Stuart, over to you to kind of run through what you think the key takeaways were from the Federal Reserve meeting this week.
I think unusually, Chairman Powell spoke in relatively simple declarative sentences, and when central bankers look you in the eye and tell you something, there are times when we should accept it just as it's said. And to that end, in this meeting, he repeated many times that the probability of both higher unemployment and higher inflation have risen. He also said that these shocks aren't yet apparent in the concrete, the hard data that we've received. And as long as that's the case, then his optimal strategy is to wait and see. And I suppose the follow-on question is what does one do whilst one waits and sees? And I think the simple conclusion here is whilst waiting and seeing, you don't cut rates. And it's significant because the market is expecting something like 80 basis points by year end. And so I think it is again sort of evidence of this tension between past policy, which seems to have conditioned the market response to expect a very near-term segue from tightening to easing, and then simple, continuous cycles, whereas the Fed is in a much more difficult situation now. And I think, again, is going to have to triage simultaneous shocks to growth and inflation in a setting where they're already wrong-sided with respect to one of their mandates. Interestingly, he characterized the thought process as assessing where the point on the map is that says you are here, and essentially discerning on which front is the Fed doing the best now. And I think that his comments, especially the first paragraph of the written statement, was actually relatively glowing. He acknowledged that there was a very significant distortion from trade, front-loading of imports, which caused net exports to push the most recent GDP data into negative territory. But underlying demand remains actually quite robust, and we think that's associated with ongoing healthy employment, wage and aggregate hours data. What I would add, I think that was somewhat new, and I think runs a bit contrary, increases the tension between the Fed and market pricing, is that Powell said that it's entirely possible that this data uncertainty persists into the third quarter. And typically the Fed will want to observe the data and then explain to the market its thought process, and then carry out policy in internally consistent bunches. So in other words, once they meet the threshold for action, they tend to do things several rate moves at a time. And if you think about that in terms of sequencing, it makes it very difficult, I think, given the data flow and absent some new exogenous shock. It makes it quite difficult to price rate cuts by year end. That remains our central, and I would argue out of consensus view about the marketplace. And the implication is that relative to the current forward curve, where all these cuts are priced, that one, I think levels are less sustainable as we price in less outright easing, and also to the extent that these expectations have steepened the yield curve. Again, our strongest view, as expressed in our forecast, is more about the slope of the curve than the level of rates or duration risk. And essentially, we think that we have a slowing economy with sticky inflation and a hesitant Fed, and that in all likelihood is going to produce a yield curve twist, flatter, whereby the long end falls in terms of outright level, and the front end of the curve more closely reflects an expectation of no move. That's the central view. We've expressed this tension for the Fed in terms of growth and inflation, and our view is that the Fed will err in the end towards defending the inflation mandate. But we do a fair amount of navel gazing ourselves, as do all investors, and so we have tried to think through the scenario in which the Fed makes a more obvious, at least, pivot towards growth. And I think that particularly if it is the same direction and magnitude as any fiscal stimulus provided by the ongoing budget process, that a Fed choice to cut rates in the presence of above target inflation and with a growth-oriented administration, you can have an explosively steeper curve. And again, here we're thinking more bearishly about the long end than in terms of Fed pricing, but we're thinking more in terms of investors concerned about future inflation. So, the Fed still thinks that longer-term expectations are well in check. We have our doubts. I think the evidence is piling up to the contrary. And just to get us to a stopping point, again, we think that in an effort to triage growth and inflation, the Fed will be compelled to err towards inflation. And that still remains, the post-Fed, the primary driver of our view.
Yeah, you mentioned that that's an off-consensus view, and of course we can see that anyway from market pricing. As you said, the market's pricing in more than 3 rate cuts for the end of this year. But I would perhaps just add that we were on the road in London this week. It was mostly a kind of UK-focused trip, if you like, although not so far from the office. It was mostly UK-focused. But we did a fast money and a real money roundtable, and we asked at the beginning of that expectations for the Fed, and there was no one who thought that the Fed would cut fewer than 2 times for the rest of this year. So yeah, we were very much at the more hawkish end of expectations. Okay, let's move away from central banks slightly then, and just move over to Europe, Joe, where the surprise on the European front this week was actually political rather than monetary policy driven. And that was that German Chancellor Merz failed to gain enough support in the first round of votes in the Bundestag to actually become the Chancellor. How worried are you that kind of sets a precedent for policy making and the potential difficulties that the current German government might face in the kind of months and years to come?
So a very surprising week, I would say. I think it was fairly expected that we would get that vote passed for the first time in the Bundestag. So that was a bit of a surprise to the markets. The second round of votes did obviously go a bit better. But I think what is clear at this point is that there is a little bit of dissent within the coalition and members of the coalition in terms of the agenda of this government. That being said, I really don't think that it has much implication for policymaking going forward. And that's for a few reasons. I think, firstly, in terms of how voting is done in the Bundestag, it is a public vote versus a vote for the Chancellor, which was a secret vote. So that means that if you do decide to dissent, that is much more obvious, which makes it a bit more politically difficult for those to do within the coalition that disagree. So I do think that the process of passing through the fiscal packages and spending will be a little bit more smooth, even though we had this hiccup this week. I think that there's obviously also room within the coalition to shift things around and negotiate if required. So that again should help to pass things through this government, even though we had this blip this week. So overall, I'm not too concerned about the ability of them to pass the fiscal measures going forward. I think obviously the biggest change, which was a shift in the debt brake, and the pushing through of the infrastructure package was done even before the government has sat in the Bundestag. So I think the biggest change has been pushed through already, and spending changes to come will also be easily passed through because of the voting mechanism that is to come. Obviously, I think there's still very little details on the spending plans. We had a headline this week saying that we could get around 60 billion in spending for 2025 in defense. And again, that's still very much unclear. A 1 percentage point increase in spending would entail around 40 billion. So I think to me, the 60 billion number does not look like it is for the tenure of the government, which because that would imply a fairly small increase in spending every year. So I think they're likely to do a bit more in the defense package, obviously given they've got so much debt space to do that. So I think the 60 billion to me seems to be more of an annual spend versus a spend for the tenure of the government. It's still very much clear that they will be doing more on defense. I think that we'll only get more details of that when the budget is passed later on this year. But I think for now it's still wait and see on German defense. But clearly the direction of travel is still to do more, regardless of this week's events.
Okay, and just to round it off then, because we would be remiss, I suppose, on a central bank focused week to not also talk about the ECB. We've obviously reflected on the fact that our sort of own central case is a bit more hawkish than market pricing for both the Fed and marginally more so than the BOE. But also for the ECB, we see that the market is pricing in a lower terminal rate than what we have in our central scenario of 2%. How are you thinking about the risks to our central scenario and how that compares to current market pricing?
So our base case for ECB pricing and ECB terminal rate is 2%. And it's been that way for quite a long while now. The market has obviously shifted a bit more dovish, really pushed by growth concerns stemming from US tariffs. So at the moment, I think around 165 is being priced, which is a lot more dovish than our own central case. And I think that for a while, we've been of the view that actually at this point in time, with uncertainty heightened, being long rates was the right approach. But I think that at this point, I'm a bit more optimistic. We've obviously had positive tones on trade deals coming from China as well as the UK deal as well, which I think bodes more positively. I think we might be past the peak pessimism of tariffs, and the market might also be past that level as well. Similarly, in the survey that Imogen mentioned that our hedge fund sales team have done, most market participants surveyed here expected the ECB to deliver 75 basis points or more in terms of cuts for this year. And that's essentially a terminal rate of 1.5%. And again, I think that was in a scenario where we had the worst possible tariff, the 20% tariff on Europe. That's what the market was pricing in based on that scenario. And I think that given that the tone is shifting a little bit, I do think there is some value in just being short front end rates at this point. I think if we think about the economic situation, yes, there are downside risks from the tariff situation, but these could be resolved or can be reduced, which will ultimately reduce the macroeconomic impact of these tariffs. But also, secondly, I think the market has discounted the impact of German fiscal spending, which, of course, if that does get rolled out, will be a positive. So counterbalancing the negative impact on growth that could come from tariffs. So I think net, there is, to me, some momentum and some value in being a little bit short the front end at this point.
Okay, great. Thank you. Well, thank you both for joining me. Thank you to our listeners for listening in. I will see you in a couple of months' time, but the rest of the team will, of course, be back next week to share their thoughts and views on rates markets. Thanks. See you soon.